Hi everyone and welcome to today's video. Today I'm going to be dealing with Option Insanity Session 1, revealing the option insanity. This is going to be the beginning, the introduction to this strategy. It is not, this first session is not meant to be exhaustive. It's not meant to be all-inclusive. This is a different way to think about options. It's a different way to think about how to sell higher PPD, more expensive PPD while buying cheaper PPD. So I want to take my time. It's worth taking the time to make sure that we cover all the bases, we set the right foundation, that you get a good understanding of this approach and the fundamental aspects behind this approach. So, as you already know, option insanity is based on my basic concept of buying cheap PPD options and selling expensive PPD options. If you have not ever watched The Power of PPD, the video, The Power of PPD, I would encourage you to click on resources in PDS Trader and watch that video now. Also, if you have not read the NDA that's posted on the updates, it's at the top of the updates. I would encourage you to read it now. Stop the video now, read it, and make sure you agree to those terms before you go through the rest of this video. Okay? All right, so having said that, option insanity is a completely different way to take advantage of this very powerful concept, and it's more so than any of my other option strategies. And in fact, it is counterintuitive to most option trading approaches. But as you will see, this approach actually captures the essence of the PPD concept. So I'm going to start by explaining the concept and by giving you a simple example outside of the option insanity strategy. So as you may know, I love selling premium. If you don't know, I love selling premium. One of my strategies sells at the money options or slightly out of the money options in the weekly option arena on relatively cheap stocks. And an example might look like this. I may look to sell a 7-day $10 strike put for 20 cents. That's a 2% return in 1 week. If the market goes nowhere, can't complain about that. Nonetheless, normally I sell the 7-day option because the 14-day option might only be worth 25 or 30 cents. So it's the 14-day option is barely worth any more than what I can bring in on the 7-day option. So in other words, the 14-day option has a smaller PPD, which it should be the case in most scenarios, right? But what if it looked like this? What if the 7-day $10 strike put is trading at 20 cents and the 14-day $10 strike put is trading at 40 cents? Now, which one do you sell? Well, the answer is the 14-day option because it has the same PPD over the next 7 days. So it's expected to devalue by 20 cents over the next 7 days. So both of them would be expected to value by 20 cents over the next 7 days. But if the stock moves higher, I'll capture 40 cents instead of 20 cents. So it's a fairly straightforward answer, and it does happen from time to time, and it does dictate whether I'm going to go a little bit longer out when I start selling options. So the amount of premium that I bring in, and obviously the PPD differences between the two options makes a difference in what I'm going to be doing. And so as an option gets closer to expiration, sometimes the entire value just isn't enough to get any kind of decent PPD. And so you have to sell the further expiration instead of the nearby expiration. And this is what option insanity takes advantage of. It takes advantage of opportunities where the longer term options have a higher PPD than the shorter term options. And it actually occurs more often than you might think, but even more importantly, it occurs more often because of the Monday, Wednesday, Wednesday, Friday, Friday, Monday weekly option relationships. And so oftentimes you can get this 2 to 4 day relationship, which is what provides most of the opportunities. Now, you can go longer out, but that's a whole different session, and I'll be talking about that. later on and explain. You'll know exactly why I don't go longer out for the most part. But nonetheless, take for example this following scenario. And I'm going to make this as simple as I can to get us started. First of all, let's say we have a 2-day option and it's an at the money option and it has an extrinsic value of 30 cents. And we have a 4-day option that's at the money and it has an extrinsic value of 75 cents. Okay, so in 2 days, the current 4-day option will only have about 2 days left. And if things occur the way they should, then this 4-day option should drop to about 30 cents. Okay, so we know this because the 2-day option is priced at 30 cents. Meanwhile, the 2-day option will have expired and there will be no extrinsic value in that option, no time value in that option because the market didn't go anywhere. I'm just assuming in this example right here that the market doesn't go anywhere. Okay, so in this example, we have 75 cents dropping to 30 cents and 30 cents dropping to 0, right? So if I sell the 4-day option and buy the 2-day option as a spread and the market goes nowhere, I should make about 15 cents on the trade. And the difference in the extrinsic value decrease is where that number comes from. Everybody see that? 75, I sell 75 cents, it drops to 30, I make 45. I lose 30 on the long option for a net profit of 15 cents in this example. Meanwhile, what is my risk if the market goes nowhere? And I just gave you a scenario of what should happen, but what if it doesn't happen? Because I'm going to tell you in most of the scenarios that you're going to see like this, it doesn't happen that way. Again, part of the details of going through this, but let's take a look at what the risk is if the market goes nowhere. Well, we know that if the market goes nowhere, the 4-day option, which is now a 2-day option, cannot increase in value, right? So in the next 2 days, if the market's going nowhere, obviously there's no volatility being infused into the market. So if the market's going nowhere, then obviously the 4-day option is not going to increase in value, in price over the next 2 days, right? So the only question is how much does it decrease? We know that because the current 2-day option is at 30 cents, that perhaps the 4-day option should also be at 30 cents come 2 days. But what if that's not the case? What if the 4-day option only decreases to 50 cents? Well, then I would make 25 cents on that option because it drops to 50 cents and lose 30 cents on the 2-day option for a loss of only 5 cents. So the short option actually only drops by 25 cents, not all the way down to 30 cents. It drops down to 50 cents, not all the way down to 30 cents. So I'm giving it a healthy buffer here. And in that scenario, I would actually suffer a loss of about 5 cents in that situation. Okay, now this scenario is highly unlikely given the fact that the market has not gone anywhere in the past 2 days. But like I said, there are situations where it may affect how much the 4-day option drops compared to the 2-day option. And I'm going to use an actual example, an actual trade that I took to explain that a little bit further here as we move along. Now, if these are call options, which they are, and the market moves down, then it is possible for the 4-day option to become essentially worthless, netting me the entire 75-cent gain. All right, so now the market doesn't stay the same, it actually moves down. I have calls, and if the market moves down enough, it is possible for the 75-cent option to go to 0 or very near to 0, giving me a 75-cent gain or very close to a 75-cent gain on the short side. Meanwhile, obviously the long side will drop to 30 cents. So in this scenario, my max profit potential is 45 cents. Okay, I want you to see that because it's very important when you're taking a look at all of the different risk metrics with any given trade. Right, so the max profit potential is 45 cents. So that's pretty decent compared to a max risk expectation, really, of about 5 cents in this scenario. If the value, the time value, remains in the short option over the next 2 days, despite what the 2-day option is worth. But what happens if the market moves higher? Well, let's take a look if the market moves higher by just simply 1 point. Then we know that the long option would be worth $1, exactly $1. The market moves up by 1 point. That means the long option is in the money by 1 point. That means it would be worth exactly $1 on expiration or at the close of expiration. And that would give me a gain of 70 cents on the long. Meanwhile, the short option would be something less than 130. It has to be something less than 130. And how do I know this? How do I know it has to be less than 130? Well, if the ATM option with 2 days left only has 30 cents of extrinsic value, then the $1 in the money option with 2 days left will most likely have less than 30 cents of extrinsic value. It's not a guarantee. I've seen weirder situations, but this is very, very common logic and very reliable logic. But let's say that it increases to $1.30. That means the $1 in the money option, $1 in the money option with 2 days left actually has 55 cents of extrinsic value. All right, so if it increases to 130, 55 cents of extrinsic value on my short option. I lose that, but I make 70 cents on my long option, which means I still gain 15 cents. See, so with this, even if there's a ridiculous amount of extrinsic value remaining in my short option, the long option moved up enough to create a profit that was bigger than what my short option extrinsic value could remain. So in order for me to break even, my short option would have to basically increase by 70 cents on a $1 move. And of course, that's not going to be the case when you have a delta that is basically sitting at about point or 50% with the at the money options. That's not that's not set in stone. I don't want to get into the Greeks and how that works with how much time is left and et cetera, because sometimes you do have a negative delta. But nonetheless, you kind of get a good feel for how this trade might work out and what the risks reward metrics are on this particular trade. So if it moves up by a buck, I can expect to make at least 15 cents. That's a very, very realistic probability on this particular trade. Now, I use this as an example to explain the concept, as usually the spread between the 4-day option and 2-day option that is at the money is not more than about $2 or excuse me, a ratio of 2. And in this example, it's actually at about 2.5. So you don't often see at the money options with a difference in value that exceeds a ratio of about 2. This one is a 2.5, and again, later on, I'll talk about the reasons why you actually might see that every now and again. And in fact, it just so happens that I recently took advantage of such an opportunity. I actually went long a 2-day at the money option for 63 cents and short a 4-day at the money option for $1.83, giving me a net credit of $1.20 on this trade. And this particular ratio is 2.90, meaning my short option price is 2.9 times bigger than my long option price. Again, very, very solid opportunity, very solid trade. However, there's a reason for this. If this exists, there is a reason for this. And in the next lesson, I'll go more into the reason for this. But this is what this looks like in a normal scenario. This is what this looks like when you're able to take advantage of this inverse volatility, if you will. It's a type of inverse volatility. It's not quite the same, so don't get it confused with some of the strategies that are commonly termed as inverse volatility or inverse implied volatility, for example. Don't get those confused because that's not what this is. But nonetheless, when you have a much higher PPD on the short option and it's at the same strike than the long option, you have a very solid opportunity, even if it doesn't work out exactly like the graph shows, because what you see here is you see this projection being a maximum risk of $28. $28, and that's it. And if the market moves up more than a point or down ever so slightly from where it is right now, there is profit potential, and that maximum profit potential goes all the way up to a buck 20. So, in other words, SPY has 2 days to move away from 292 in order to avoid the projected maximum loss of 28 bucks, and with any significant move in either direction providing as much as a $120 gain, and the loss range is about a point. Now, in this scenario, it's probably a little bigger, like a point and a half, 2 points. By the way, it did move away from this, so that's a mood. I don't know what it would have been had it stayed in that area, but it did move away, and that particular scenario provided a decent profit. So in reality, the maximum loss is probably a little closer to $50 in this situation because there is something propping up the short expiration more than normal, which is why the ratio is higher than normal. But when you have a higher ratio, it also means that you have more room for error. And so just because that exists, that scenario exists, doesn't mean that this isn't a solid opportunity. It is. It just means that you have to prepare for a little bit bigger potential risk. So here is step one. Step one, I told you we're going to kind of go through this slowly, make sure you understand what we're doing. Step one is selling a further expiration and buying a closer expiration, a nearby expiration. That's step one with option insanity. Every single option insanity strategy uses that as a criteria. We sell the further expiration and buy nearby expiration. Now, obviously, you can't just throw these together nilly-willy and expect to produce some trades. There is a rhyme or reason. There are reasons why it works. We'll start to address those, and I already have started to address those today with that first example, and we'll certainly get into this in much more detail as we continue to move forward in these lessons. So step one is sell further expiration, buy closer expiration. What is step two? Well, step two is to create a higher PPD with the shorts and a lower PPD with the longs. Okay, again, sell the expensive PPD, buy the higher PPD. Okay, so we're going to move in that direction. We're going to start to look for things that have that. And this, if it worked out, by the way, this particular example already achieves that, which is why it has such a tremendous risk reward ratio. Now, obviously, again, 2 days, it has 2 days to move away from 292, and the profit potential there in moving away from 292 either direction looks really good. Um, Absolute minimum loss, it's absolutely capped, very small. So that example already creates the higher PPD with the shorts and the lower PPD with the longs, and it's just two legs, one option each. But let's look at a couple of different ways of doing that with this option insanity approach. So what I'm going to do in this example is I'm going to buy the 2-day option that is 2 points in the money. Buy a 2-day option that's 2 points in the money for 220. Now, if it's 2 points in the money and it's priced at 220, what is the extrinsic value? 20 cents, right? So not very much extrinsic value in there. Then I'm going to sell the 4-day option that's at the money for $2.08. Now, if it's at the money and it's priced at 208, how much of that is extrinsic value? All of it. So I have a total of 20 cents of extrinsic value on my 2-day option and $2.08 of extrinsic on my 4-day option for a net debit. It's still a net debit of 12 cents. And so my 2-day option, since it has 20 cents of extrinsic value, is 10 cents PPD, and my 4-day option is at 22 cents PPD. So not a bad situation. Okay, not the best, not a bad situation. Here is the projection graph for that particular trade. And you'll notice here that because there is a debit on this trade, that means there is a minimum risk to the downside of $12. It's a 12-cent debit. That means it's a $12 risk minimum to the downside, while the maximum risk comes right at the long strike, and that's always going to be the case. You know this from my other lessons. If you've listened to any of my other strategies, when I'm explaining how these options work in conjunction with one another, When you're long an option, the maximum risk almost always occurs at that long option strike, whatever it may be, or the minimum profit potential if it happens to be a risk-free projection trade. So there's no difference in that with the option insanity approach. Okay, so maximum risk projected to be about $100 at the 290 level. That's probably pretty accurate. It can either be a little bit higher or it can be a little bit lower, but that's pretty accurate. The maximum profit potential, on the other hand, is going to be the strike difference minus the debit. The strike difference minus the debit. So the strike difference here is 2 points. The debit is 12 cents. That gives me a maximum profit potential of $1.88 to the upside. That's $188 to the upside. Okay, so that means that the probabilities that are associated with this trade as is are absolutely positive. The mathematical probabilities of this trade are absolutely positive. Now, it's not the best trade in the world, like I've said, and the reason is because the higher probability move, or especially over the next 2 days, is going to be either 2 points to the upside or 2 points to the downside, or somewhere within that range. And the probabilities or the average win-loss ratio within that 4-point range is about the same. All right, so that creates a scenario where you have a higher probability of breaking even or doing slightly better over the long term, because what you have to do is you have to have the outliers. That's what's going to create the profit potential in this trade. You have to have where the market moves up more than 2 points and down more than 2 points. All right, so if you have, for example, two trades where the market moves up 4 points on one of them, and so you go from 292 to 296, where you're going to make about $150 if it moves up. But if it moves down $4 or 4 points, it's going to go from 292 down to 288. Well, you're only going to lose about $50. All right, so you make 150, you lose 50. That's a positive gain, net gain between the two trades of $100. So on the outliers, that's where you're going to make money. But most of the trades are going to be closer to within that range. And so again, not the best trade. Now, interestingly enough, and again, you may know this from some of my other lessons, but strike manipulation is not hard to understand. So what I'm going to do is I'm going to replace the 2-day option, 2-point in the money option, with a 2-point out of the money option instead, because it has essentially the same extrinsic value. It's valued at 20 cents. All right, so the 2-day in the money option, or the 2-point in the money option, had 20 cents of extrinsic value and $2 of intrinsic value. But the 2-point out of the money option only has 20 cents of extrinsic value, right? So it's essentially the same thing. The difference here is that you're creating a credit of $1.88 instead of a debit of 12. So now what you have is you have a scenario where the maximum profit is a credit, and that occurs to the downside, and the maximum risk, which is the strike difference minus the credit, or plus the credit if you want to use it that way, it's $12, and that's to the upside. So it creates exact opposite end for the profit potential and the risk potential. All right, that's what happens when you just move the strike. It's a relationship between where the long strike is and the short strike is to make it either bearish or bullish. So if the long call is below the short, it creates a bullish scenario. If the long call is above the short, it creates a bearish scenario. Now, that's interesting, right? That's interesting because what happens when you combine these two? What do you think happens? Well, if you recall, the max risk at basically a 2-point move to the upside is about $100 in this example, and it's about $100 in this example, only to the on the other end. However, the profit potential to the upside, if you go up 2 points, is $100 on this one, and the profit potential to the downside on this one, if it goes down to about $1, is excuse me, down about 2 points, is also $100. And so what happens when you combine these two? Well, this is what you get. All right, so you get a projection. This is a risk-free projection trade. It's not the best in the world, um, and this is just the beginning of creating an option insanity trade. I'm just, again, I'm getting your mind into the flow of what it is that we're trying to achieve when we start looking at these types of opportunities when it comes to selling further away expiration versus buying nearby expiration. And so this is the beginning of creating an option insanity trade. And again, I'm not a huge fan of this particular trade because the bigger profit potential is further away. Right? So in other words, the market has to move up. Just to make $100, the market's going to have to move up from about 292 all the way up to 296-ish, so about a 4-point move. And to the downside, it's going to have to move from 292 to about 287.50, maybe 288, and that is projected to give me a $100 profit. And in the middle here, it's projecting about a $50 profit, and that's again, depending on what's going on in the market, that may either be realized or it may be something less. And then these two peaks can also drop below the zero line. Now, if you're familiar with my other strategies, you know that that's a higher probability. In a different scenario, this is a higher probability of these peaks dropping below the zero line. Not so with this opportunity. It's less common than it is, far less common than it is common for that to occur. So this is not an unrealistic expectation. It might be off slightly, but it's not far from reality because of the vast difference in the PPD values between these two options. Okay, so again, this is just the beginning. I'm introducing you to the concept of what the option insanity approach is. And in the next lesson, I'm going to go over manipulating the strikes for desired profit range. And I've already started that process by showing you how to put the strikes in relation to one another to create either bullish or bearish trade, very similar to other approaches that I've done. And then I'm going to introduce the weighted option insanity spread. And this is where it gets insane, is when you start learning how to create excessive selling PBDs or short PBDs by weighting the trade. So that's really where this strategy is going. And then I'm going to be talking about addressing the risks of the weighted spreads because there are extra risks and they do have to be addressed. But as you will see, addressing them not hard, and often you can address not only the risk but securing a certain profit potential with what I'm going to show you. And then I'm going to be showing you and dealing with the differences between the Monday, Wednesday, Wednesday, Friday, Friday, Monday relationships, and they are all different for various reasons. And so that one is a little bit more. I may or may not get to that one in the next session. If not, it'll be dealt with in session 3. Before I end this lesson, I know you're probably all chomping at the bit to see the actual some of the actual trades that I was talking about in the promotional material. And so this is one of the trades where I said, here's one of the trades where the profit potential is in the middle. I told you I didn't like this particular trade as much. It's not one of my favorites because the bigger profit is in the outlier, right? It's either a big move up or a big move down, or a decent move up, a decent move down. Well, this trade, the profit potential is right where the market is, believe it or not. And then the risk, the market actually has to move down about 4 points from when this trade was placed in a matter of 2 days. And then that risk is very limited and very narrow range to the upside. There is no projected risk. So it's a tremendous trade. And then, of course, this is the risk-free projection. This is a weighted spread with the max profit potential again in the middle. And again, these can actually drop below zero. Highly unlikely that it's going to, if they do, that it's going to drop below zero by any significant amount. And again, in the next lesson, I'm going to show you why it's virtually impossible to realize that max risk, even if the market is hovering around the 289 or 295 level. All right, so here is one actual trade that I recently took, and this particular trade, I give the details, I give the exact fills, and this is the graph that was the projection graph. Now, I was willing to take the risk, but I was willing to take it to the upside. And the reason that that's the case is because of the day relationship. There are different opportunities for different day relationships. And don't worry, you're going to get a template. Here are the typical Monday, Wednesday opportunities. Here are the typical Wednesday, Friday opportunities. Here are the typical Friday, Monday opportunities. And so you can take all of them, or you can take one a week. The best are generally the Friday, Monday opportunities. Most of the time, not always, but most of the time, with regard to being able to address the risk, and I'll explain that again. But here's one trade that was taken. Here's another trade that was taken, and as you can see here, that's the trade that only has risk at about 288, or excuse me, at 289 actually. I have a similar trade where the risk is at 287, and you can combine these. That's again another lesson. A lot of details with this, but getting understanding the concept is the most important aspect of it. But again, that's another trade, and there will be many, many more examples as we continue moving through the lessons, and obviously as you get the reports. Consequently, I take about, I want to say anywhere from 5 to 7 opportunities every single cycle. So Monday, Wednesday, Wednesday, Friday, Friday, Monday. Not necessarily because they're all the best opportunities, but because that's just how I like to prove out my approach. And even the best opportunities are really good, or not. Even the not the best opportunities are still really good for the most part. And so I take between 5 of 7 of these every single cycle. So I have a wide range of direction that we can go with these, and I'll be showing you those as we move forward. All right, so my suggestion is that you do not attempt to place any of these trades on for yourself until after at least session 2, and that's because there are other things that have to be addressed, namely the margin. When you put on this trade, they require extra margin. In some accounts, they won't even let you put this trade on. Again, I'm not going to go into that in this session. There's a very simple way to address that, and I'll go into that more. But you do not want to try and put these trades on without addressing that, and certainly you don't want to put these trades on without addressing the risk. Okay, so just be patient, and we will get there. It is well worth it. I'll see you in session 2.